Hello and welcome to this session in which we would look at corporate formation, specifically under Section 351. We will discuss this from a tax strategy perspective. When investors start a corporation, when individuals start a corporation, what they can do, they can contribute cash to the corporation, and the corporation in return will give them ownership, stocks. Well, if the new owner, if the investor contribute cash, it's not a big deal at all. If you contributed $100,000 in cash, you expect to receive $100,000 worth of stocks. There's no gain. The cash value is clear. They gave you in return equal amount of stocks. How about if you contribute an asset other than cash? What can you contribute? You can contribute any asset. You can contribute a piece of land. You can contribute a building. You can contribute cars, vehicles. You can contribute a boat, equipment, so on and so forth. Well, under those circumstances, is there any tax implication? In other words, let's assume you bought this piece of land for $100,000. Now it's worth $160,000, and you contribute this piece of land to the corporation. Are there any tax consequences? Or you bought it for $100,000, now it's $80,000. You're contributing an asset at a loss. How about when you contribute an asset and there is a liability attached to that asset, a loan attached to that asset? These are the issues that we have to deal with when it comes to Section 351. So as CPAs, as tax professionals, we have to be able to advise the individuals how should they form the corporation, what are the tax consequences. And this is what we will discuss in this session, dealing with corporations. Corporations here we mean C and S corporation. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. So when the owners contribute property to a business, the tax implication all depends on the structure of the business. Specifically for corporation and specifically for C corporation and S corporation. Now, if you don't know the different form of businesses, what is a C, what's an S, look at the prior recording. I reviewed all form of businesses. The rules for whether such contribution can be made without incurring any taxes is governed under Section 351. Section 351 is the name of the Internal Revenue Code. Just, you need to know that when you contribute property, Section 351 apply. And guess what? If Section 351 applies, there are no tax consequences. And we will explain the rules and how to use those rules as a form of a tax strategy to advise client. Now, the reason is there are no tax consequences. The reason why Section 351 applies. Congress says, well, if you're an investor and you contribute property to the business, what happened is this. This is a continuation of your investment. So simply put, you still own the property through the corporation. But there are certain rules you have to comply with in order for the transaction to be tax-free, in order to transfer this asset, whatever this asset is, land, building, without incurring any taxes. If you qualify under Section 351, guess what? We assume it's a continuation. We assume too there are no, all what you're doing here is you're taking your asset and turning them into the corporation that you control. This is important. Therefore, you still owe them. You still own those property. They're still yours. Therefore, there are no tax consequences. So understanding Section 351 is important to avoid paying taxes on such contribution. First, we have to contribute property. This is important. Property versus services. Now, if we contribute cash is easy. Whatever we contribute in cash, the value is easy. So what we're contributing is property, not services. We're not contributing our effort. That's what services is. Owners can contribute property, which include both tangible property and cash, as well as intangible. You could also give intangible property. In return, you are getting stock. you are getting a form of ownership in the corporation. The contribution must be in exchange for stock, not other form of compensation. They're not giving you something in return like cash. If they give you cash, then you're selling this asset to them. That's not what you're doing. Ownership threshold. This is important. This is what makes Section 351 Section 351. After the exchange, the contributors, the people that contributed those assets, whether that's one individual or group of individuals, must own at least 80% of the corporate stock after this contribution, ensuring they have significant control. And this is where the continuation of the ownership, the assumption is there is you own 80% or more of the contribution after 80% or more of the corporation after the contribution. And that's why it's a continuation. You still own the same property, but through the corporation that you control. If you don't control the corporation, then Section 351 don't apply. And this is the trick here. This is the trick, is to structure the transaction in a way, and we're going to see in an example, to make sure we meet the 80%. Now, in the regulation section, we learn about the rules. Here we have to how can we help an investor contribute property and that contribution is tax-free? So, when Section 351 are met, no immediate tax. This is the whole purpose of Section 351. Neither the contributing shareholder nor the corporation will recognize any immediate gain or loss from the contribution. And the whole purpose of this is to facilitate the formation of corporation without any taxes. Congress don't want to put hurdles in front of investors to form corporation. Now, basis adjustment for shareholder, we would look at this in a separate recording because there's a lot of factors, but generally speaking, the shareholder basis and the new acquired stock will be the same as their adjusted basis in the property, minus any debt that the corporation agrees to take. Don't worry, we'll look at the basis for the shareholder in a separate recording, but the point is your basis will transfer to the corporation. Now, if that asset has any liabilities, let's assume you contributed an asset with $100,000 of net book value or basis, $100,000 in basis, attached to it $30,000 of liabilities, your net contribution is $70,000 because the net asset minus liability equal to $70,000. Now, basis for the corporation basis in the property received will be the same as the shareholder adjusted basis prior to the contribution, which is what? The basis that you had. This ensures continuity in the tax treatment of the property. Remember, the assumption is it's in your hand. Now it's in the hand of a corporation that you control. Nothing have changed, and that's why there are no tax consequences, assuming Section 351 applies. If Section 351 are not met, well, then what you have to do, it's if you sold it, you have either a gain or a loss if the transaction does not meet Section 351. The contributing shareholder must recognize any gain or any loss, and this means what? You have a tax consequences. Adjustment in the basis of both the shareholder and the corporation will increase by the amount of any gain recognized by the shareholder. So if the shareholder recognizes any gain, it's going to increase their gain. It's going to increase their basis, which is good. It means in the future they don't have to be taxed on that amount. Because once the amount is taxed, the gain is taxed, it gets added to your adjustment. This adjustment reflects the change in the value of and potential tax liabilities resulting from the contribution. Now, what are the benefits of Section 351? To summarize, it offers tax-efficient way for shareholder to do what? Contribute property and form corporations as long as they meet certain conditions, specifically control after the contribution. It encourages the pooling of resources by providing tax relief when the specific ownership and exchange are met. You contribute property, you control 80% or more in a group or by yourself, guess what? The conditions are met. And in return, you're getting stocks. Now, failure to meet these criteria would lead to tax consequences. So this tax system aims to do what? The balance for the need for corporation to raise capital through contribution. They want to encourage you with the IRS interest in maintaining tax revenue, but the IRS wants revenue. Now, the key in all of this, okay, we know the rules, that's fine, is when you already have ownership, you have two owners, and they own 100%, then you have a third one joining. Well, if the third one joining, well, if somebody own already 100%, they have to contribute a lot to get 80%. Basically, they have to kind of take the ownership, reduce the ownership of others. So how can we create
a business transaction where the third owner, after the contribution, is tax-free. The best way to illustrate this is to work an example. So let's assume we have Taylor and Morgan. T&M are shareholder of Green Corporation, holding 70% and 30%. So Taylor 70, Morgan 30. Bailey wants to become a 20% shareholder and contribute property with a basis of $40,000 and a fair market value of $160 in exchange for stock. Let's assume we just Bailey said, okay, great. Taylor and Morgan agree. They gave them 20% and they contribute the property. What are the tax consequences? Well, after the contribution by Bailey, there are tax consequences because Bailey controls 20%. Well, what does that mean? It means if they have a property with a fair market value of 160, basis of 40, guess what? They're going to be taxed. It's as if they sold it, and they will be taxed because the Section 351 is not met. They must report a gain of $120,000, which is taxable. And the basis of the stockholder for Bailey and the corporation is 160, which is good. Now their basis is higher, so when they sell the stock down the road, they'll be in good shape in a sense that their basis is 160, not 40. They will have less gains to recognize. But they recognize the gain now, which is the 120. Now let's change the scenario a little bit. Let's adjust the scenario. Let's assume Taylor, remember Taylor in the example here, already owns 70%. Let's assume Taylor decides to contribute additional property to the corporation along with Bailey. Now we're going to get T plus the new owner, Bailey. Together they're going to contribute the property. Taylor right now owns 70% and has a fair market value of $700,000. Taylor planned to contribute property with a basis of $30,000 and a fair market value of $100 for an additional 10%. Now what does that mean? It means Taylor is contributing 10%, which is through a property basis of 30, fair market value of 100. Now what happened is, for Taylor to be part of this section, his contribution must not be of relatively small value compared to his existing stock. So in other words, you cannot just contribute a small amount. The contribution with a fair market value at least $70,000. What's $70,000? Because right now, Taylor owns 70%, or his value in the corporation is 700 out of $1 million. So for Taylor to be counted in this contribution to qualify under Section 351, he must contribute at least 10% new property. 10% means the fair market value of the new property has to be at least $70,000. A substantial amount, so he can be counted. $100,000 is more than $70,000. Therefore, now what's going to happen? We're going to count Taylor in Section 351. Now, if Taylor and Bailey contribute together, because Taylor contribution has a fair market value of 100, it surpasses the threshold of not being relatively small. This allows Taylor to be considered part of the group. Now what's going to happen is this. Taylor is 70% initially, plus 10% new, plus the 20% of Bailey. Guess what? We exceeded 80%. What does that mean? It means the transaction becomes now non-taxable. Now, Bailey's basis on the stock remained 40, and Taylor's stock basis increased his property basis by $30,000 because he contributed a property of 100 with a fair market value of 100,000. Now we can ignore the fair market value. Why? Because Taylor don't have to worry about this because this is Section 351. And remember, Bailey's fair market value is 120. We ignore the 120. We're using the basis because now the transaction is what? Section 351. So Green Corporation and the property received from both are 40 for Taylor, 30 for Bailey. 40 for Bailey, 30 for Taylor, which are their adjusted basis. So if we look at this example, if Taylor had contributed the property with a fair market value less, he would not qualify because it has to be at least 10% of your existing ownership to be a substantial, not very small contribution, because the IRS don't want someone just to contribute $1 and be counted towards Section 351. This is what we do. In this example, demonstrate how strategic contribution by existing shareholder can help new investments in a corporation while optimizing the outcome for themselves as well as for the new shareholders. Now we also have to be aware of contribution of services. What is services? If you don't have money and you want to join a corporation, they would say, okay, you're an accountant, you're a CPA, you're a lawyer, you're an architect. Why don't you work for us for a year or two? Then we'll give you a certain ownership in return. Well, this is you're not contributing property, you're contributing services. Well, Section 351 specifies that you have to contribute what? You have to contribute property to a corporation. So what happens if you contribute services? If you contribute services, you have, my friend, wages, and wages are ordinary income. You're taxed as ordinary income. Why? Because it's as if you did the work, they gave you the money, then you gave them back the money in exchange for stock. Therefore, services are not counted as property. Therefore, it's not included under Section 351. This means when a shareholder contribute only services in exchange for stock, such contribution are treated differently from property contribution. Just again, how are they treated? It's wages for the person. So, services exclusion. Shareholder providing services in exchange for stocks are not included in Section 351 shareholder contribution group. They must recognize income equal to the fair value of the stock received. This is how they establish their basis, whatever the fair value of their services. Now, the exclusion of service-only shareholder can affect the ability of the remaining shareholder to meet the 80% necessary, because you are excluding this individual that he or she contributed 30%, but you cannot count it. How about if this individual contribute both services plus property? So you're doing some work and you are contributing property. How about now? Can you be counted? Well, there's a threshold. If the primary goal is to meet Section 351, the property must not be minor compared to the services value. What is minor? Well, a threshold is used, and that property value should be at least 10% of the stock value received for services to qualify. In other words, the property, it has to be at least 10%, equal to 10% of the services you're providing. Let's take a look at an example to see how it works, to make sure the mixed contribution is counted. Well, H&A, Harper and Alex, are forming Nova Corporation. Harper contributed land of $90,000 with a fair market value of $300,000. Alex, a marketing expert, provided $200,000 worth of marketing services and also contributed an antique collection with a fair market value of $30,000, basis of $10,000. Well, Harper here will have what's called mixed contribution. Well, Harper contributed land. Harper contributed only property. She's included in Section 351. Harper does not recognize any gain. Why? Because it's Section 351 and her basis in the Nova is $90,000, which is there is no gain recognized. Alex, here they have a mixed contribution, services and property. Well, to be included, the value of the property must not be of relatively small value. Well, since the antique had a fair market value of $30,000, is more than 10% of the service value, because 10% of $200,000 is $20,000. Guess what? We exceeded this threshold. Now Alex can join the Section 351 group. Now we have 351 transaction. Alex recognizes income. Remember, Alex still recognizes income, a taxable income for the services provided that doesn't make the services tax-free, taken a basis on the stock received for services at its fair market value of $200,000. However, the property part, since it qualifies, Alex takes the $10,000 basis in addition to the stock received for the antique collection, and no gain is recognized on this part of the transaction. Simply put, if I ask you what is Alex's basis, it's $210. The services that Alex provided plus the $10,000 of the basis. Now, Nova Corporation basis, the corporation basis in the land is the basis, which is $90,000, and $10,000 in the antique collection. Why? Because that's the basis. The services provided are recognized as income by Alex and do not affect Nova's corporation basis. Simply put, just basically it's as if they're paying them wages. How about if you contribute property that's already at a loss? So you're contributing a property, but the property is at a loss. You have a piece of land, the basis for that is $100,000. Now the fair market value equal to $70,000. What does that mean? It means this property has a loss of 30,000. This is a built-in loss. The loss is already included in the property. When the shareholder contributes property to a corporation in which the fair market value is less than the tax basis, well, this is what we know as built-in property. The ability to utilize the loss depending on whether the transaction meets Section 351 or not. What are the main points of built-in loss? Shareholder can only recognize and utilize the loss if the transaction does not qualify under Section 351. Why? Because Section 351 is a non-recognition event covering both gains and losses. Now, what is the best strategy if you have a built-in loss asset? Sell it. So the advice will be, if you have a built-in loss with a built-in loss property, what should you do? Sell it. Sell the property, recognize the loss on your tax return, because that's what you want to do. Then use the proceeds to contribute the money, the cash, to the corporation, and this way you can be part of Section 351. Let's take a look at this example. Jordan and Taylor are setting up Quartz Corporation. Jordan contribute equipment with a tax basis of 50 and a current fair market value of 30. So let's stop right there. What does that mean? It means this asset has a basis of 50, fair market value of 20, we have a built-in loss. Well, if Jordan contribute the equipment directly to the corporation in exchange for stock, and the transaction qualifies under Section 351, Jordan cannot recognize the loss. The corporation basis in the equipment would be the carryover basis, which is 50,000, but the loss remain unrealized. What would you advise? What will be your advice here? Sell the asset. Recognize the $20,000 gain, contribute the cash. So Jordan recognize a loss if they sell it, which is the difference between 50 and 20. This way Jordan can claim the loss and take the cash and contribute this cash to the newly formed corporation and be part of Section 351 and help other investors to qualify as well. Boot received. What's boot received? When a shareholder contribute property to a corporation in exchange for stock, sometime what happens is you will get, you remember when we started, we said you contribute cash, they give you back stock. What if they give you back stock plus something else? What's that something else? They could give you some other property. They could give you cash back. I don't know. They give you some sort of a boot, some sort of a compensation, which can be cash or other property. Specific tax implication arises here. Boot complicate things because without the boot, Section 351, it's clear cut. Section 351, no tax consequences. If you receive a boot, you have tax consequences because now you received something in return. Let's assume you received cash or any form of property. In the eyes of the IRS now, you are receiving something in return. Well, you have the ability to pay taxes. So the boot is basically, the boot is what? The boot is a compensation to you, and the IRS says, whoa, hold on a second. You're getting something in return. You can pay the taxes. Now you have the ability to pay taxes. It's not a continuation of your investment. You're getting something extra. This is what the boot is. So the boot could be cash. You're getting something in return. It doesn't have to be cash, but think of cash as an easy way to remember. So the presence of a boot in a transaction requires the shareholder to recognize the gain. However, the gain is limited to the lesser of total realized gain on the transaction or the fair market value of the boot. So you have to choose between the lesser of these two. And we'll work an example. The value of the boot is subtracted from the shareholder initial basis in the stock received. And we'll talk about how to compute the basis later. However, the gain recognized due to the boot receipt is then added back to the shareholder stock basis. Don't worry, we're going to look at the basis in a separate recording. Now, how about the corporation? The corporation basis and the property from the shareholder is adjusted also upward by the amount of the gain recognized by the shareholder. And this makes sure that the tax implication of the boot are reflected in both the shareholder and the corporate tax basis. Again, we'll work a comprehensive example about the basis for both the shareholder as well as the corporation, including boot, boot receive, services, property, so on and so forth. So Robin contributes property to Delta Corporation. The property has a tax basis of 100, fair market value of 150. Oh, what does that mean? It means in the absence of anything else, we have a gain of 50,000. Are we going to recognize the gain or not? If we stop right here, there's no gain if it's Section 351. However, Robin receives stock valued at 140 and a cash of 10,000. So what did they give Robin in return? They did not give him 150,000 worth of stocks. They gave Robin 140,000 and they gave Robin $10,000 cash. What does that mean? The cash is the boot. Are there tax consequences for Robin? Yes. Robin will have to compute the gain, the realized gain. The realized gain is 50. The boot is 10. The lesser of the gain or the boot is the amount that's taxable, and I hope you know 10,000 is less than 50. So the realized gain is 50,000. Gain recognized is only 10. The lesser of 10 and 50. 10 is lesser and lower. Therefore, Robin would recognize a gain of 10,000. So basis, Robin's initial basis will be the basis of property receipt, property contributed, 100,000. But since Robin received 10,000 and that 10,000 is taxable because you already pay taxes, now the boot minus the boot received is 90,000. Then, because Robin recognized the gain, and once you recognize the gain, it means the gain is taxable. This is the cash. Then the gain is taxable. You add back the gain, you're back to 100,000. Again, we'll work a comprehensive example for basis explaining how basis how boot affect the basis. Now, Delta Corporation basis in the property is initially 100,000, then they increase it by the gain that's recognized by Robin, resulting in a new basis of 110,000. Then we could have another scenario where the corporation assumes the debt of the shareholder. So when the shareholder contributes a property to a corporation that's connected to a liability, that's associated with a liability. What does that mean? You have a piece of land that's $100,000. Comes with that piece of land is 30,000 of liabilities. Really, what you contributed your net contribution is how much? 70,000. Your net contribution is 70,000. But what happened is this 30,000 is gone. You're no longer responsible for it. Why? Because the corporation is taking over this liability. So the corporation agrees to take on this liability. What does that mean? How do we treat this? Here's what we need to know about assumption of debt. Well, the basis of the stock that the shareholder received in exchange for the property is decreased. Okay, you contributed 100,000, but there's a debt of 30,000. Your net contribution is 70,000. You gave me net asset of 70,000, because if I want to go ahead and own this asset, I have to do what? Pay the bank 30,000. Well, if you gave me something for 100, I have to pay someone 30,000. What you gave me is 70,000. Therefore, we have to reduce the debt. So the basis of the stock that the shareholder received is decreased by the total amount of the liability that the corporation assumed. And this reflects what? The reduction in the shareholder economic investment. Why? You are contributing a $70,000 property, not 100,000. Now, if you contribute a property and there's excess liabilities. Let's go back to this $100,000 piece of land. You have a $210,000 debt on that land. This is the debt against that land. Hold on a second. What are you saying? There's more debt than the basis of the land. Yes, the land could go up in value. Now you have a negative. If you take the basis minus the debt, you have a negative basis. Well, what does that mean? For the shareholder, they cannot have a negative basis. Their basis is 0. Then, because the liabilities is in excess of the tax basis of the asset contributed, this excess basis is a gain for the shareholder. Gain for the shareholder. So the shareholder simply put it's as they received 110,000 extra money in their pocket. Why? Because they no longer are responsible for this debt. The corporation took over the debt. Therefore, the 110,000 is a gain, and their basis and their stock is 0. So while the basis of the stock cannot drop below 0, any excess liability over the property basis is recognized as a gain. And this gain represents economic benefit. the shareholder receive beyond their initial investment. You contributed something with 100,000, but you are responsible for 210, but you're no longer responsible for that. Well, it means you received 110,000 in value. Now, the corporate basis under those circumstances is the greater of the adjusted basis if there's a liability or liability assumed. Now, why do we do this? If we go back to this example, 100,000 and there's a liability of 210. What does that mean? It means the corporation cannot own this asset free and clear unless they pay 210. It means the basis for them is 210, liability assumed, the greater of shareholder adjusted basis or liability assumed, because they can't have it unless they pay the debt. So if you want to own something and enjoy it free and clear, you pay off the debt. If you pay off the debt, that's my basis. That's my basis in the property. Jordan contributes a building to XYZ Corporation. The building has an adjusted basis of 300 and it's subject to a mortgage of 350. XYZ Corporation agreed to assume the mortgage. So notice here, the debt is 350. The basis, the tax basis, is 300,000. What does that mean? It means we have more debt than the tax basis. Well, Jordan is happy to kind of get rid of this asset because it's they have a negative equity in it. But that extra 50,000 is what? That extra 50,000 is a gain to Jordan, and Jordan basis is 0. Because technically, I mean, if you really think about it, their basis is negative 50. You cannot have basis negative 50. You can, but the gain, if you recognize this as a gain, so you'll start, theoretically, you're starting at negative 50, then this is why we add the gain, because you're gonna pay taxes on the gain. Negative 50 starting at the basis. Again, think of it, there's no negative basis, plus the gain of 50, your basis are 0. So initially, Jordan basis in the building is 300,000. With XYZ assuming the mortgage, Jordan needs to adjust his basis. But when we take the basis minus the liability, we have a negative number. Well, we cannot have negative basis. Therefore, the basis is 0. Then we recognize the gain. Well, basis is negative 50, but there's no negative. Then we recognize the gain. Once we recognize the gain, we add it back. We're up to 0. So instead, Jordan recognized a gain of 50, which is the difference between liability assumed and the property. Jordan final stock basis end up to be 0 because the liability assumed exceeds the property basis. Now for the corporation, to own this property, they have to pay 350. That's their basis. Let's take a look at this multiple choice question from farhatlectures.com. Which of the following is not, be careful, a requirement for a transaction to qualify under Section 351 non-taxable exchange? You need to know this inside out. Which one is not? Like, we don't need this for a transaction to be Section 351. The property is transferred solely in exchange for stock. Yes, we need this. We want property in return for stocks. The transaction involved the contribution of services. Do we need this requirement for the transaction to be Section 351? Do we need contribution of services? I would say no. But B looks like a good answer. Let's wait to look at C and D. The transferors, more than one, could be more than one, notice, control at least 80% of the corporation immediately after the exchange. Yes, this is a requirement because we're looking at not a requirement. So that's good. So we can eliminate A, we could eliminate C. D, property include both tangible and intangible asset. That's fine. You can contribute both tangible, it means physical asset, and intangible asset. That's perfectly fine for both. D is the answer. What should you do now? You want to go to Farhat Lectures, look at additional MCQs, additional resources. That's going to help you with your CPA exam, enrolled agent, tax course, any professional certification you are working on. Invest in yourself, invest in your education. Good luck, study hard, and of course, stay safe.